Stop for a second. Silver isn't drifting, it's ripping. Spot just punched straight through multi-year resistance, the kind of levels that held for months, sometimes years. And it didn't ease through them. It blew through them fast. This wasn't a slow grind higher. It was an overnight repricing. Futures volume spiked, physical premiums widened, exchange inventories started thinning. That combination matters because this isn't speculation hunting for a headline. This is something different. If you're holding silver, watching metals, or stacking anything tangible, you're already involved in what's happening right now. And if you're watching this today, you're ahead of the crowd that won't notice until coin dealers start rationing supply and spreads blow out enough to make headlines. I'm not here to tell you silver is going to the moon or crashing tomorrow. I can't do that. Nobody can. What I can do is walk you through the patterns that repeat when metal markets shift from calm into stress and show you the signals you can watch yourself so you don't need anyone else to tell you what's real. Because here's what most people miss. What looks obvious on the surface is rarely what actually moves markets. The real signal is almost always hidden in the plumbing. And right now, that plumbing is flashing stress. Before we go deeper, hit subscribe. Not for hype, for protection. We don't chase headlines here. We track stress before it screams. And drop a comment letting me know where you're watching silver from and how long you've been following metals. I want to know who's actually in the room. So let's talk about what just happened, and more importantly, why it matters. What most people saw was simple. Silver surged. Safe haven flows picked up. Geopolitical risk and debt anxiety climbed. Gold moved higher, and silver followed. Hard. Momentum traders piled in. Futures contracts multiplied. Charts broke resistance. That's the headline version. What you probably didn't see, unless you were looking in the right places, is where things get interesting. Lease rates started climbing. That only happens when someone needs to borrow metal short-term and there isn't enough floating around. In a normal market, lease rates are boring, flat, forgettable. In a stressed market, they jump. Physical premiums widened. The gap between spot price and what you actually pay for a coin or bar started blowing out. If this were just paper speculation, that wouldn't happen. Paper trades are unlimited. Metal isn't. Exchange inventories started falling. The warehouses backing futures contracts, especially the registered category, the metal actually available for delivery, are shrinking faster than eligible stock is replacing them at places like COMEX. And positioning became one-sided. Open interest rose, but not in a balanced way. This wasn't hedgers and speculators passing contracts back and forth. Metal was being pulled, not just traded. These aren't retail signals. This is the plumbing. And when the plumbing starts groaning, price follows whether anyone's paying attention yet or not. If this were just another commodity pop driven by momentum and headlines, those numbers would look very different. Sit with that for a moment. Let me give this setup a simple name so you can recognize it again when it shows up in the future. I call it the flow squeeze. Picture a fire hose connected to a garden pipe. The fire hose is paper, futures, options, ETFs. Unlimited pressure, unlimited flow. The garden pipe is physical metal. Bars in vaults, coins in inventories, deliverable ounces that actually exist. When demand surges, the pressure doesn't leak. It lifts the price. First, futures buying accelerates. It could be fear, inflation hedging, or pure momentum. The reason doesn't matter. Contracts multiply faster than metal moves. Second, the shorts who sold those contracts face a problem. If buyers start demanding delivery, or even if the market starts to smell delivery stress, those shorts need to source real metal, not promises, not paper, actual ounces. Third, inventories thin. Available metal gets pulled from exchanges, from dealers, from anywhere it's sitting loose. The pipe narrows, pressure builds, and price doesn't drift higher, it jumps. We've seen this before. In 1980 with geopolitical chaos. In 2011 during sovereign debt panic. In 2020 when liquidity froze overnight. Every time paper demand outran deliverable metal, and repricing wasn't optional. This doesn't require a conspiracy. It just requires math. If 100 people hold claims and only 30 ounces are floating around, someone doesn't get metal. Price decides who. Right now, futures volume is rising while registered inventory falls and physical premiums widen. That's not a headline. That's the valve tightening. And this is where most rallies either fail or turn into something else entirely. Your job isn't to predict which path this takes. Your job is to recognize the structure so you're not surprised when it moves. There's another layer here that matters just as much, and it has nothing to do with short-term sentiment. Silver responds to confidence. Not sentiment, confidence. Sentiment is how traders feel about next week's chart. Confidence is what institutions, sovereigns, and large holders believe about the stability of the system itself: currencies, balance sheets, trade flows, and debt. When confidence in financial hedges leaks, capital doesn't vanish. It reroutes. And it reroutes into tangible collateral. Gold always moves first. It's the anchor, the monetary metal, the thing central banks hold quietly and rarely sell. But silver lags until it doesn't. Silver is smaller, thinner, more volatile, and cheaper per ounce. When gold pulls capital into the safety trade, silver often catches that wave later. But when it does, the move is violent because the market is a fraction of gold's size. Think of gold as the dam and silver as the spillway. Slow pressure builds behind the dam and gold absorbs it. But when pressure surges, silver doesn't just follow, it overshoots. Right now, gold is rallying on debt anxiety, geopolitical risk, and steady central bank buying. Silver rode that slipstream and then started moving faster than the gold-silver ratio would normally suggest. That ratio, the number of ounces of silver it takes to buy 1 ounce of gold, has been compressing fast. That's a tell. It says the confidence valve isn't just cracked, it's opening. I'm not saying silver is about to double or collapse. It could reverse tomorrow if risk calms and positioning unwinds. But the structure we're seeing right now, thinning inventories, rising lease rates, widening premiums, a shrinking ratio, has historically preceded moves that don't wait for permission. The next move won't be announced on TV. It'll be rationed at your local dealer. Here's the mistake most people make. They ask, how high can silver go? That's the wrong question. The real question is, who gets metal when everyone wants it? Because if this is a flow squeeze layered on top of a confidence leak, the stakes aren't about bragging rights or percentage gains. They're about access and timing. Price is something you see on a screen. Access is something you discover when you try to act. I've watched rallies where spot went vertical and dealers sold out in 72 hours. Premiums doubled. Wait times stretched into weeks. Some buyers got filled early. Others paid 20% over spot or couldn't buy at all. I'm not saying that will happen again. I'm saying the conditions that allow it to happen are live right now. And that's not speculation. That's plumbing. From here, there are really 3 paths, and none of them are predictions, just structures. One path is continuation. Risk headlines stay hot. Gold keeps pulling capital. Silver rides momentum higher. Premiums stay wide. Inventories keep falling. Shorts cover or get forced out. Early holders benefit. Late chasers learn expensive lessons. A key signal here would be backwardation, near-term futures trading above later months, visible stress in the curve, published daily by places like CME Group. Another path is pause and consolidation. Headlines cool, positioning unwinds, futures roll off, premiums narrow, silver drifts or pulls back. Patient buyers win, breakout chasers don't. You'd see lease rates drop, inventories stabilize, and premiums compress. The third path is a shakeout and resumption. A sharp pullback scares weak hands out. Then physical tightness and confidence erosion reassert themselves, and the move resumes from a higher low. Disciplined buyers benefit. Emotional sellers regret it. The tell there is elevated delivery demand and wide premiums even during pullbacks. I can't tell you which path we're on, nobody can. But you can watch the signals that tell you which structure is active. That's the edge. Here's what I'm watching this week. I'm watching how spot and futures behave. In calm markets, futures trade slightly above spot. In stressed markets, that spread flattens or inverts, signaling someone needs metal now. I'm watching warehouse drawdowns and delivery notices. Normal markets drift, stressed markets drain, especially in registered inventory. I'm watching physical premiums. 3 to 6% over spot is normal. 10, 15, 20% tells you stress is moving from paper into the real world. I'm watching lease rates and short-term funding stress. Near zero is calm. Sudden positive spikes mean someone's scrambling for metal, with data coming from sources tied to the London Bullion Market Association. And I'm watching the gold-silver ratio. Slow drift is normal. Fast compression means silver is outperforming because the trade is broadening or tightening. Your job isn't to predict, it's to interpret. If you're trading, respect volatility. If you're holding long-term, understand what you own so you're not shaken out by noise. If you're on the sidelines, this is real-time education in how markets reprice under stress. It could reverse tomorrow. It could consolidate for months. It could accelerate into something bigger. What matters is that you're learning to read the signals instead of waiting for permission. The people who survive these moves don't watch headlines. They watch plumbing. Headlines tell you silver is rallying. Plumbing tells you why and what to watch next. If you're here right now, you're ahead of the crowd that will only notice when premiums double and supply gets rationed. That's not luck. That's preparation. So tell me in the comments, which signal are you watching most closely right now? Lease rates, premiums, inventories, or the ratio? And if you lived through 1980, 2011, or 2020, share what you learned. Pattern recognition beats guesses every time. And remember this one thing as you go. You don't chase squeezes. You recognize them. Paper trades sentiment, metal trades reality. And reality doesn't wait for consensus. Stay sharp, stay ahead. We'll see you in the next one.